This is Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And I'm going to start today's blog utilizing Johnson & Johnson & Company. I've got a 20-year chart up here of Johnson & Johnson. You can see this company has grown earnings at 12.7% over this 20-year period. And the blue line represents approximately 15 times earnings, which is Johnson & Johnson's normal price-earnings ratio, or I would even say fair value price-earnings ratio. And then the black line, of course, are stock prices. And you can see there have been periods here over this last 20 years where Johnson & Johnson's stock price has become extremely overvalued. So today's blog was talking about the Great Predictor, and the Great Predictor is valuation, and it's so important in the investing process, yet it's mostly ignored. And I'm going to try to use a couple of examples today to show you really how important valuation is and how you can rely on it to predict future returns. And by the way, as a sidebar, I also believe it's one of the reasons why I think equities are so attractive today, because today valuations are low. But we're going to start by looking at when valuations were reasonable. And if I start with Johnson & Johnson here, you can see that in the beginning of this period in 1990, it was in value at around 15 times earnings, or maybe even maybe even slightly above that. And then it ended the year at around 12.7 or 12.5 times earnings, but it was in value and kind of, near value, from the beginning point to the end point, and therefore a $100,000 investment in Johnson & Johnson should give us a number that equates very closely to its growth rate. So now when I check that number based on just appreciation alone, no dividend consideration, I have no dividends on this chart right now, you can see that a $100,000 investment in Johnson & Johnson grew to about $753,000. That's about an 11% rate of return, significantly better than the stock market, which had nothing to do with this. It was all about Johnson & Johnson, and it equates very nicely to the 12.7%. But let's go back in time and look at some of these other periods and see what valuation or overvaluation actually did to shareholder returns. Before I do that, though, I do want to make one final point. There are periods of time here where the stock price was significantly above its normal valuation. Those were anomaly periods or periods of overvaluation. We have a situation like that occurring now because of the recent recession and the stock collapse. So what I'm going to do is I'm going to look at Johnson & Johnson. I'm going to stop at 1997 here, where I have a period where, there was at least some normalcy. We start with some normalcy and end with some normalcy, just so you can see how the calculations work out. What I'm really trying to focus on here is how valuation actually impacts rate of return. So let's take a look at now this 18-year period where we ended it in 2007. Johnson & Johnson is modestly overvalued at this point in time, and it started, moderately overvalued. As you can see, remember the scale here is harder to see because it's so little. But over this 18-year period, the company's earnings also grew at about 13.7%. So the company delivered good operating results. Shareholders earned about a 13.1% rate of return, which is very consistent with their earnings growth because it started in value and ended in value. So next, let's look at a period where Johnson & Johnson's stock price became disconnected from its intrinsic value and became overpriced. That would be at the end of 1999 or from the period 2000 forward. And let's examine, because of overvaluation, what happened. Remember, now we have a 13.7% growth rate currently. So let's look at this period of overvaluation, which is a shorter period now, 8 years. But interestingly enough, we still have approximately the same growth rate, 13.4 versus 13.7. But because Johnson & Johnson's stock price was overvalued, look what happens to shareholder returns. Instead of the 11, 12, 13% number we saw before, the rate of return drops now down to 3.4% compounded annually. Remember, this is an annualized number, and it's really a factor of the fact that it was overvalued starting out in this period, yet it still achieved approximately the same growth. The next example I want to use is Wal-Mart, because I think it really tells a very compelling story. We go back to the 20-year chart, and I'm going to bring it up to current because Wal-Mart was overvalued by my definition of this being the actual valuation. Also, I took that blue line out because I want you just to see it from a standpoint of earnings. If this earnings line, which represents 15% growth, represents Wal-Mart's value line, you can see that it was somewhat overvalued at the beginning of in the middle of 2008 before we had the market correction. So it actually was slightly overvalued at the beginning. It ended a little undervalued, and so you have a 15% grower that, when it was all said and done after 20 years, gave about a 12% rate of return to its shareholders over time. And clearly, this is a 20-year period. Valuation was a contributing factor, given the fact that it had 15% growth rate. But look what happens if we just look at this last 10 or 12 years here, or the period starting from calendar year 2000. Now, from calendar 2000, Wal-Mart still had an impressive growth rate as it's become a much bigger company. It still grew at 11.5%, not quite the 15 it was averaging over the 20 years. But look at the valuation now. Now you clearly see that the valuation was significantly, higher than its normalized, say, 15 times earnings. It's, of course, trading at around 14 times earnings here during this period. But what I want you to notice is we had great earnings growth here. We had started out with an overvaluation period. So even with this great earnings growth, we actually ended up losing money holding Wal-Mart for the last 10 years because it was simply overvalued at the beginning of that period. It did slightly better than the market, but nevertheless, it was overvaluation that contributed to the poor results and not the business. And that is the critical point that I'm trying to make here. So to kind of bring today's post to a conclusion, if we take a look at the S&P 500, the general stock market, the point I was making in the blog is you can see where, back in February of 2000, the S&P, or let's say in the year 2000, the S&P was trading significantly above its earnings justified level, which is normal, a PE ratio of about 14 times earnings. And of course, that really led to very, very poor returns during that period of time. As you can see today, there are two things I want you to take notice of on the general market. First of all, we have the normal price earnings ratio of 14 times earnings. We're very close to it at 14.5 times earnings. So right now the market is very reasonably priced. But I also want you to point out that earnings are depressed from the recession. The last recession we had in 2001 led to several years of earnings growth, which I alluded to in the blog. If earnings do recover and companies begin to accelerate their growth again once we have a strong economy, not only do we have depressed valuations today, we also have depressed earnings, and if both of those things begin to grow and go back to normal, the leverage here could be incredible. A classic individual example to make my point would be Danaher Corporation, and this is some people would call this a conglomerate, but it's really a manufacturer and marketer of professional, medical, industrial, and consumer products. One of their best-known products is the Sears Craftsman tools, but they also make medical technology instruments and other things. But the point is, you can see this is an extremely well-run company. It's had extremely consistent growth. There have been periods in the past where growth rates have flattened a little bit, and then they resumed their growth rate. It's currently forecast to have kind of a flat to down year in 2009, but I want you to notice that the valuation right now is as low as it's ever been on this, this is a 16-year chart on Danaher here, and we've never seen it, really trade only a couple other times at a discount to its valuation. Today it's trading significantly. You can see the stock price already moving up, and my point is I believe earnings are going to turn up again for this great company, number one, and number two is I think as they do, the stock price is going to come back to its earnings justified level, and therefore that's where you have the leverage I talked about in the written part of my blog. You're going to have this returning to more normal valuations and then growth on top of that. When valuations are low, you can be very, very confident that the returns that you can earn in the future should be very, very attractive, assuming your companies continue to perform as you expect. And with great companies like Danaher, I think that's a pretty rational assumption. And this is Chuck Carnevale saying thanks for listening and look forward to talking to you again tomorrow.